Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at NVTS Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. When we talk about NVTS, we are talking about a company that's trying to be the essential plumbing for the next generation of computing.
Now, plumbing, okay.
Yeah, they're a category leader in high-efficiency power semiconductors, but their specialty, and this is key, is in these advanced materials, gallium nitride, or GaN, and silicon carbide, SiNaLi.
And for listeners who aren't electrical engineers, why should we care about GaN and SiNaLi? I mean, why isn't standard silicon good enough anymore?
That is the core of their entire competitive edge. These materials, they allow power chips to switch much, much faster and handle far higher voltages than traditional silicon. So in a world of massive data centers and, high-speed electric cars, that translates directly into efficiency and, crucially, managing heat.
And for AI, that's everything.
It's non-negotiable for AI. Racks are demanding unbelievable amounts of power. This technology is what keeps them from, melting.
Which brings us to their major strategic pivot. It seems like they've realized selling low-margin chips for, phone chargers. That's not the future.
Exactly. That won't cut it when the real money is being spent on electrification. So they are actively shifting resources away from those legacy consumer segments.
Doubling down on the big stuff.
Doubling down on the highest margin, next-gen verticals, AI data centers, electric vehicles, and solar power.
And this is all defined by these highest-end power demands. We keep hearing about 800-volt-plus architectures. That's Navitas's playground. Why is that specific voltage so critical for a company like NVIDIA right now?
Think of it like a highway. Your standard systems run at 400 volts. That's like a smaller country road. But to move the sheer amount of energy that a massive AI factory requires, you need a superhighway. That's 800 volts. Navitas's chips are the specialized parts that can handle that voltage and density.
So if you want to build the infrastructure for the AI revolution efficiently.
You knew what they're selling. Simple as that. Now let's peel back the layers on the fundamentals, because this is where you see the massive trade-off in this whole pivot.
Right. It's not all smooth sailing. On the upside, they're showing growth, even while they're restructuring everything.
They are. Trailing 12 months revenue for fiscal 2024 is at $83.3 million. That's rapid expansion. They're outpacing most of their high-performance power semiconductor peers.
The growth story is absolutely compelling.
But here's the critical counterpoint. The cost of admission to this AI party.
It's expensive.
It is. This aggressive expansion comes with a massive price tag. The company is operating at a significant loss. TTM net income is hovering around negative $125 million.
Wow. That's a staggering cash burn. We hear analysts aren't worried, but what's the realistic downside if those big AI contracts get delayed by just 6 months?
It could be fatal. That $125 million loss isn't just a bad number. It's the cost of repositioning the company. It's all going to R&D, high operating expenses, and restructuring.
So management is basically telling the market to be patient.
That's the signal, yeah. Revenue will stabilize before sequential growth returns. But the long-term outlook appears positive, and it's supported by cold, hard cash.
Right.
Analysts don't expect earnings to accelerate until, say, mid-2026. That's when those big AI and EV contracts are expected to really ramp up. And crucially, their balance sheet is solid right now. They've got a cash position of about $150.6 million.
And that position was just bolstered by a major capital infusion, which to me shows some real institutional conviction.
It absolutely does. They just did a private placement.
One for about $100 million, right?
Exactly. They raised about $100 million from 14.8 million shares. And that cash is just vital for funding these growth initiatives. But, that does bring up the risk of dilution, which we have to keep in mind.
Okay, let's talk about their competitive advantage, their moat, because this is where the story really locks in for me. They're not just another chip supplier.
No, they're not. The difficulty for competitors is trying to replicate Navitas's integrated design expertise and, maybe even more importantly, their supply chain leverage for these specialized GaN and sexy materials.
Well, not easy to copy.
These are not easily replicated barriers to entry.
And we've seen those barriers get stronger with their recent collaborations, right? Like that joint lab they launched with GigaDevice.
Yes, in October 2025. That wasn't just a handshake. It was a real commitment to accelerate digital power solutions, specifically for AI data centers and EVs. That shows deep integration.
And then they went even further and engineered themselves directly into the AI factory infrastructure.
They did. Also in October, they introduced new modules tailored specifically for NVIDIA's 800-volt AI architecture.
That's a massive technical validation.
It proves they're not just aiming for the market, they're building foundational products that are necessary for the largest player in the game.
Let's shift to the technical picture, because the market has been screaming conviction here, even with all the fundamental risks.
Explosive is an understatement. The stock has seen just massive momentum. We're talking a 393% increase year over year. It's more than doubled just this year.
It tells you the market is fully buying this pivot. They're buying the future revenue story today.
And the volatility, of course, comes with that. I mean, we saw huge volume surges, like the stock jumping over 24% in a single day back in July.
And then after those key data center contract wins in Q3, it just soared. 96% over 5 trading days. This thing moves like a rocket.
That velocity is intimidating. When we look at the chart, what are the crucial levels investors should be watching?
Okay, so key technical support is holding right around the $7 level. Your short-term resistance is up around $8.50.
As moving averages. The important thing is that the price is trading comfortably above both its major moving averages, the 200-day simple and exponential. That suggests a fundamentally bullish structure long term.
But with those huge spikes, volatility is clearly part of the trade.
Absolutely. The stock's beta is high, around 3.1, which just means you should expect outsized swings. 3 times the market.
Okay.
However, the RSI, the Relative Strength Index, is currently neutral. It's not overbought, which suggests there's still room for it to run without triggering an immediate pullback.
So while the growth story is strong, we have to talk about the recent bumps. The pain of the pivot is very real.
It is. The Q3 report gave us a taste of that. Shares plunged over 21% right after that report.
Why the big drop?
The revenue dip was just stark. It came in at $10.1 million versus $21.7 million year over year. That plunge was the market's fear response to seeing the immediate hit from abandoning their old business.
So let's just reinforce the core risks here.
First and foremost, profitability. Net losses will persist until those new AI and EV segments fully scale. The timeline is tight.
Right. And second,
Dilution. That $100 million capital raise, while necessary, plus any stock-based compensation, it adds shares to the float and puts pressure on future earnings per share.
and the biggest risk is just execution, right? I mean, semiconductor demand is notoriously cyclical.
It is. If they fail to scale those high-margin verticals quickly enough to offset the consumer decline, it could seriously jeopardize their timeline and their cash.
So what's the scenario if their AI customer ramp-up gets delayed by, say, 9 months?
Well, if that happens, the market will start treating that $125 million annual loss as a persistent drain, not a strategic investment. Their liquidity buffer, while strong now, will shrink. They might even be forced into another dilutive capital raise.
So execution isn't just everything here.
It's survival. They have to hit that mid-2026 earnings target.
Okay, switching gears to the immediate future. What are the catalysts that could drive the next leg of momentum over, say, the next 3 months?
We've got a packed schedule coming up. All eyes should be on the preliminary Q4 results due January 7th, 2026.
And then the full earnings report.
Right. The full Q4 and full year 2025 earnings on February 11th. These reports are the litmus test. They'll confirm how fast that AI and EV business is ramping.
Any good news there could really move the needle.
It would send the stock flying. And beyond the financials, you need to watch the smoke signals from institutional money. We've got ETF rebalancing in late December, and then institutional buy disclosures around January 20th.
So if we see the big funds loading up,
It could signal a powerful shift in institutional sentiment. And you can't forget the buzz and the speculation. The rumors are often a leading indicator in this sector.
definitely. There's chatter about a major supply agreement with a global cloud service provider for their 800-volt modules.
That validation alone would pretty much secure the entire AI thesis for them.
And what else?
There's also industry buzz about accelerated AI chip roadmaps to keep up with NVIDIA's demand, which means NVTS might get pulled forward faster than anyone expects.
And then there's always the M&A talk.
Always. Given their leadership in Genen and Selchi, they're a persistent takeover target for a larger chip behemoth who wants to instantly acquire that tech edge. So, bringing this all together, the analyst consensus is decidedly bullish. You've got 6 buy ratings, target ranges stretching up to $13.
And that confidence rating aligns perfectly with our overall thesis. I mean, we'd lean strongly bullish on this one. maybe an 8 out of 10.
The rationale is clear. You have this explosive technical momentum meeting clear leadership in structural, multi-decade growth trends, AI, power density, and EV electrification.
Plus, that dense pipeline of near-term catalysts just in the next quarter.
Exactly. So this is a stock that offers two clear ways to participate. It's attractive for short-term trading, trying to capture those catalyst moves, but it also has compelling long-term potential by leveraging those huge secular tailwinds.
The key takeaway here isn't just watching the revenue numbers, but watching the customer announcements. Are they securing multiple diverse Tier 1 AI customers? Or are they overly reliant on just one or two? That diversification will truly de-risk the entire pivot.